Welcome to the Margin Call, where market mechanics meet strategy.
44 hours. That's how long it took for a bank with over $200 billion in assets to go from business as usual to seized by federal regulators. Not 44 months, not 44 days, 44 hours. In that window, depositors pulled $42 billion out of a single bank. That's about $400,000 a second, sustained, for an entire business day. It remains the fastest bank run in American history. This is the story of Silicon Valley Bank. And it's not really a story about fraud, or a rogue trader, or a criminal scheme. It's a story about something much scarier. A bank that did nothing illegal, followed the rules as written, and collapsed anyway. Let's open the file. Silicon Valley Bank wasn't a normal regional bank. It was the primary banker for the startup world, venture-backed tech companies, founders, and venture capital funds, heavily concentrated in one industry and one deposit base. During 2020 and 2021, that industry was flooded with cash. Interest rates were near zero, venture funding was booming, and startups were parking enormous piles of cash at SVB. Deposits nearly doubled in 2 years. SVB now had a problem every banker would love to have. Too much money coming in, and not enough loan demand to put it to work. So SVB did what many banks do with idle deposits. It bought bonds. Specifically, long-term, seemingly ultra-safe U.S. Treasury and mortgage-backed securities. Billions and billions of dollars of them, locked in for 10 years or more, at the low interest rates available at the time. Here's the asset side of the balance sheet. Cash-like deposits coming in from thousands of startups. Here's the liability side. Those same deposits, which could be withdrawn at any moment. And sitting on the asset side to back it all up, a mountain of long-term bonds that wouldn't fully mature for a decade. That mismatch, short-term liabilities funding long-term assets, is the fault line running underneath this entire story. Then the Federal Reserve did something those bonds were not built to survive. It raised interest rates at the fastest pace in 40 years, trying to fight inflation. Here's the mechanic that matters. When interest rates rise, the price of existing bonds falls. Think about it simply. If you're holding a bond that pays 2% a year and suddenly new bonds are paying 5%, nobody wants your old bond unless you sell it for a lot less than you paid. The higher rates climb, the more those old bonds are worth on paper. SVB's multi-billion-dollar bond portfolio, purchased when rates were near zero, was now sitting on massive unrealized losses. On paper, SVB was still solvent, as long as it never had to actually sell those bonds. The losses only become real the moment you're forced to convert them into cash. And that's exactly the trap that was about to spring. March 8, 2023. SVB announces it has sold a large chunk of its available bond portfolio at a loss of about $1.8 billion, and that it needs to raise over $2 billion in new capital to shore up its balance sheet. The message was meant to be routine and reassuring. Instead, it did the opposite. It confirmed the fear that the entire industry had, that SVB's bond losses were real, not just theoretical. It was, in effect, ringing a bell that the fault line had cracked. Because SVB's clients weren't ordinary retail depositors. They were startup founders and venture capital funds, highly networked, plugged into the same group chats, the same Slack channels, the same Twitter feeds. Prominent VCs began advising their portfolio companies, in real time, to pull their money out. Not eventually. That day, March 8, 2023, SVB announces it has sold a large chunk of its available bond portfolio at a loss of about $1.8 billion, and that it needs to raise over $2 billion in new capital to shore up its balance sheet. The message was meant to be routine and reassuring. Instead, it did the opposite. It confirmed the fear that the entire industry had, that SVB's bond losses were real, not just theoretical. It was, in effect, ringing a bell that the fault line had cracked. Because SVB's clients weren't ordinary retail depositors. They were startup founders and venture capital funds, highly networked, plugged into the same group chats, the same Slack channels, the same Twitter feeds. Prominent VCs began advising their portfolio companies, in real time, to pull their money out. Not eventually. That day. This is where 2023 broke every historical assumption about how fast a bank run can move. In the past, a bank run looked like a line of people outside a branch, physically limited by how many tellers could process withdrawals in a day. SVB's depositors didn't need a teller. They needed a banking app and a Wi-Fi connection. Withdrawal requests can move as fast as a click. On March 9th alone, depositors tried to pull $42 billion. That's not a slow bleed. That's nearly a quarter of the bank's entire deposit base, gone in a single trading session at a velocity no regulator had ever modeled for. By the morning of March 10th, SVB's own estimate showed it would end the day with a negative cash balance of about $1 billion. There was, quite literally, no way to open for business. At 11:20 a.m. on Friday, March 10th, 2023, California regulators shut Silicon Valley Bank down and handed control to the FDIC. For a brief and genuinely tense weekend, an enormous question sat unresolved. What happens to the roughly 90% of deposits at SVB that were uninsured, above the standard $250,000 FDIC limit? Because they belong to businesses with large operating accounts, payrolls to meet, and bills coming due on Monday. Regulators made an emergency decision. Invoking a systemic risk exception, they guaranteed all deposits, insured or not. The Federal Reserve simultaneously rolled out a new emergency lending facility, letting other banks post those same underwater bonds as collateral at face value instead of fire sale prices, to stop the same fault line from cracking anywhere else. But the fear didn't stay contained. Within days, Signature Bank was seized as well. First Republic Bank, sitting on a similar mismatch of long-term assets and skittish deposits, wobbled for weeks before ultimately being sold off in pieces. Even Credit Suisse, an entirely separate institution on another continent already weakened by years of scandal, got swept into the same wave of confidence and was absorbed by its rival UBS within days. None of these banks failed because of some new scheme or scandal. They failed because they were all standing, in one form or another, on the same fault line: long-duration assets, funded by deposits that could vanish in an afternoon. So what actually broke here? It wasn't fraud. Silicon Valley Bank's bonds were real, safe, government-backed assets. The problem was duration risk, the mismatch between how quickly your liabilities can walk out the door and how slowly your assets convert back into cash. It's a risk every bank carries to some degree. SVB simply carried an unusually concentrated, unusually large version of it, sitting on top of an unusually networked, unusually fast-moving group of depositors. And that's really the modern twist on an old story. Bank runs have existed for centuries. What's new is the speed. A panic that once took days to spread through a line outside a branch can now spread through a group chat before lunch. Every margin call, every bank run, every squeeze we've covered on this channel comes back to the same underlying idea. Risk doesn't disappear. It just waits quietly until the conditions change. Silicon Valley Bank looked fine for years, right up until the exact moment it didn't. So here's the question worth sitting with. If the fastest bank run in history was powered by a smartphone, what does the next one look like? And how much faster could it move? That's the file on Silicon Valley Bank. If you want the next case cracked open, you know what to do. This has been the Margin Call.